The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. And we started the show today. I posted into Tiger TV the chart of the 30-year Treasury bonds, and overlaid on top of it is the 10-year Treasury note, which is about 6 times the volume of the Treasury bonds, maybe even more. It's by far the most liquid of all the commodities. But as you can see, it is made an ABCD Gartley pattern on a sell mode, whereas the Treasury bonds were able to go up and match the 50% retracement up at that 139 level. The Treasury notes were not able to do that. Folks, this is really significant for higher interest rates. It really is, because that 10-year note is what determines, what interest rates are going to be charged. Just to give you an idea of the importance of this, I'm going to show you what it's been like. I'm going to put them in about a year and a half at a time, just to show you that this divergence that we're having here is just incredibly rare. I mean, just if you go back, we'll just go back 5 years to make it quickly, to make it see it easily, but you'll not see a divergence like this in all the 5 years that that you go back. I don't care how far you go back. If you find it, it's going to be an outlier event, no matter what. So this is really important. Interest rates are getting ready to go higher, and that's the bottom line from what this chart is telling me. We topped on these bonds, several years ago with that big butterfly pattern up at the the 154 level, and now it looks like we're heading to the downside. This is very important divergence, folks. I think this is probably one of the more important charts that you'll see from me this year, but it really is important. Now, if it should change, if the notes and the bonds take off, and notes can get above the 120. 6.5, 127 level, then I would say this chart had failed, and that interest rates are in fact going to go lower. But as it looks right now, interest rates appear to be heading to the upside. So that's a very important thing to remember. Interest rates have had very little to do with the stock market, in my opinion, except that the credit is so easily available, and that might have made speculation a little bit more, because we do have, record number of people borrowing money for their stocks, and that's what they should be doing, because they go up every single day. Today's low, we have not broken a fib point in so long. I think it was back on April 15th is when we had our first major fib point break at that big cycle low on April 15th. Today's low in the S&P was just right 61% of the previous day's low. The NASDAQ, however, the QQQ was able to take out the previous day's low by just a little bit, and of course has already come back to be up on the day. The Dow Jones came down to about the 786 of that level, and that was about it, is what we're looking at. Now I'm going to show you the 10-year note by itself, because you'll be able to see here that it has been in a pretty significant downtrend here since last September. We've had lower highs, and we just completed this past Gartley. I've had a request to take a look at TBT, which is one of the ETFs for the Treasury bonds. And I do have that in my portfolio here. I don't look at it very often, but I do. And it also is showing the same thing here. We're at a major spot here in these. In fact, we hit it yesterday. If you'll give me a second here to try to get this hooked up correctly and get all the data in so we can see it a little bit better. Yeah, you're seeing the exact opposite. This would be the opposite of what we're looking at here. This would be the TBT. And as you can see, we've completed a butterfly pattern down here at the 127, which this is also telling us that we are looking at higher interest rates. That's what it appears to be looking at. Because when you buy the TBT, basically what you're doing is you're shorting bonds. And with bonds being down today, the TBT has to be up, and that's why you're seeing it in that correction. So, or making that type of correction. So we'll have to assume that this is correct. I don't like the ETFs. I feel like Warren Buffett that they're the weapons of mass destruction. I don't know what's going to happen if these things ever start to get really volatile and we have to worry about counterparty risk on some of these things. Then I would really begin to be a little bit careful of what's happening with these ETFs. But that's not for me to figure out. They calculate them when they want to and how they calculate them. So it's just really amazing. The only two that I've ever seen that looked really good were the GLD and the SLV, the ones that on the ETFs for the gold and silver. They're okay. It appears like it, but some of these others, they don't even have any indication of what's happening with some of these things. So that's primarily what we're looking at. Now, I was going to have Rich Anderson on today, but Rich is not able to come because he's at a meeting in Chicago, and he's not able to get to a landline during the half hour that I usually had him scheduled for. But we've had a little bit of a bounce in some of these grains, and of course the corn bounced and went down and made new lows. But we'll take a look at the wheat first, because it's the one that has the best pattern of anything for a potential bottom. And I emphasize this word potential, folks. As you can see, 2 days ago, the wheat came down to the 520 level per bushel, and it had a rally of 20 cents up to 542. That was the 786 of the high we made back on the 16th. And then it sold off almost another 20 cents today. It came down to the 61% retracement, and then so far rallied up to the 61% retracement. So wheat is starting to add some volatility to the mix, and that's what you really need to have happen. That's what we're starting to see in stocks, folks. The volatility index is having these spikes and then pullbacks and spikes and then pullbacks, and that's the kind of thing that you're looking for. When Basil's show was on before my show, he talked about the importance of that 1041, excuse me, the 1141 level, and the low today was 1142, and yesterday's low was, I believe, 1141, which was a 76% retracement of the whole move from 10 and change up to 15, and the 786 back brings it in at 1141. So if that index in the VIX index would get just a little bit stronger today, somewhere above 1175 or 1180, that would tell us that this top that we're having in the market today could very, very well be very important. Now, we had a P-index date yesterday. It was a value of 1, which is the smallest value that you can have. They go from 1 to 3 or 14 and more. And the number of times we've had that has been 8 times in 300 years. And that's only 8 samples. You can't really make a significant prediction on anything like that. But the fact that it is just a very rare event. Now, the good part about the index is the fact that it doesn't have any orb to worry about. It's either the day before, the day of, or the day after. So this is the day after. And if the market closes higher today, you'd have to assume that the P-index, if it takes out those highs, was not working again either. And now we're also over the Bradley date, and the Dow has not taken out the highs of July 3rd as of yet, but it's not very far behind. So we'll see if that's the case. Since we've only got a few seconds here, well, we got a few minutes, but let me just take a look here. I wanted to mention to you the main thing that I watch with the stock market is the New York Stock Exchange Index. That's the biggest of all these indices, and we are still in the zone here where we're at the 786 retracement. The strength yesterday took it from the 618 up to the 786, and frankly, if it gets any stronger today, you would have to think that this thing is probably going to go up forever, or at least, give me 1 second here so I can get this into the fit it so that it'll fit the screen. But we did hit the 786 today to the exact tick, and we'll see if that's going to be any resistance at all. I watch CNBC in the morning just to see if there's been a cataclysmic event of some kind or a geopolitical something or other, just to see what news is out there, to see what might move the market. And there's such complacency that it's really amazing me. One of the commentators on today, quite a rather young fellow, about the same age as my cat, said that there was just absolutely no way that this market could go down. It might sell off for 2 or 3 days, but there was no way there was going to be any significant correction in this market. All the factors were so bullish that there was just no way that could happen. And I imagine he's done a lot of research on this, so I don't want to make a big deal out of it, so we'll wait and see. There is one particular, just give me 1 second here. If I wanted to show you I know what I want to do. I've got it right here, and that's the Japanese yen. That's one of our favorite cross rates. We're making a really nice Gartley pattern here. We think that the index is, this dollar yen is going to go a lot lower, and at the present time we are completing a Gartley off of the highs that we made in late June. It's coming in right at the 61% retracement at the 101.80 level. And so that's one of the things that we're looking at. This market's been up 5 days in a row after the bottom was made, and it's made a 61% retracement. So it should be in an area where it should run into at least a little bit of resistance. So we will find out in the next few days if this is going to be a correct movement or not. Now, I'm going to start the VIX right now, and then I want to get to the rest of the commodities later. Hopefully I'll be able to finish it in this few minutes here. But this really shows pretty much what Basil was talking about in a chart format. The market went up to this 15 area, 1540 on the Ukrainian Gaza Strip thing, and then it's backed off to the 786. Today's low in the market was the VIX was exactly 1 tick higher than the close yesterday. Whether that means anything, I'm not sure. But if this can close above the 1225 level, that would tell us, to me, by looking at the VIX index, that this index has held 3 higher bottoms now, and it is a possibility that it could get ready to move. Folks, if the VIX index can move almost 40% in 1 day, that should mean something. Pay attention. There's people out there that are really, they might be complacent, but they're a little bit scared. Okay, we got the Dow up about 11 and the S&P up 5.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Folks, and I posted into Tiger TV the chart for the cash S&P 500, and then I also enlarged it so you could see what's happened over the last 4 or 5 weeks. We've been making these consecutive highs, and we've been coming down and stopping exactly at a major Fibonacci point on the retracements, and so the market keeps making these highs to the upside. We're completing a three drive to a top pattern now, along with a butterfly pattern in the S&P at this level. So we'll see if this is going to be any resistance or whether it's not going to be. Now, the next market that I want to talk about is the gold market, because we've been looking for a target somewhere coming in down around the 1282 level. We're only about $9 away from that level right now. After we hit the 61%, let me get a little larger size on this so we can see it a little bit better here, and we'll be able to see it. After we made the 61% retracement, we went up to that 1345 level, which is a very important level. And now what we're doing is we're forming a what I think could be a bullish Gartley pattern coming here in the 786 level of around the 1260 level. That's going to be the level that I think is going to be the next major level of support. That will come in right around 1265. And we'll see if this is going to be a good spot to be looking at the gold. There's a chance that the 1282 level could hold the gold, but we'll have to wait and see. We've had so much selling in so many of these commodities. By the way, another important thing that happened this week that not many people pay any attention to, fortunately Rich Anderson does, and he lets me know about it. CalPERS, which is the California Pension Fund people, have pulled about 40% of their hedge fund monies, most of it from commodities and stuff, and have moved it into other vehicles. So they've given up on commodities, and the hedge funds that do this have been serving them pretty well over the years, but evidently they've decided to make a change. And my guess is someone from the Harvard Business School or the Wharton Business School with about 3 months' experience was able to give them a nice presentation on why that was probably the wrong thing to do at that time. Now, gold is in a real critical point, folks, because if it goes below the 1240 level, we've got big problems. I think gold could easily break 1,000. We've got a caller from New Jersey, I believe. Victor, are you there?
Yeah, I'm there. I was wondering, you think this is a setup for next Tuesday and Wednesday when the Fed meets and comes out with another statement?
Victor, I can promise you one thing, okay? I am the very last person on Janet Yellen's speed dial.
Yeah, well,
honest to God, they never tell me anything.
No, I'm saying it spiked on the 24th of June. Now it's coming back into the same price when she came out with her announcement.
It certainly could. I mean, it can do anything you want, and the markets are always emotional around Fed time, in both ways, both up and down. So I try not to have a big position. I might have a small position on into the Fed, but I really don't. I really don't do much.
How are interest rates going to go up? How are they going up if the 10-year keeps on going down? I don't get what you're talking about.
Well, the 10-year is the real interest rate because that's the rate. The Fed sets the rates at the discount window, whether I think it's 0.5% now or whatever it is, but that's what they set. They don't give us those rates, Victor. You understand that, right? Because the Federal Reserve is a bank for bankers. It's not the Federal Reserve for Victor and Larry. It's the bank for bankers. So they really don't care what happens to you and me. They might say that they do, but frankly, they don't. So
no, it's the richest corporate people in the world. There's like 30 people that control it. I think
probably something like that. But that's the last thing that I have to worry about is the Fed, because they're not going to tell me what they're going to be doing. But I react to what happens in the market.
Well, when their statement comes out on Wednesday and they say they're going to raise rates in October, you think the market will ever finally?
They might have a down day in something. It might have a down day. I don't know. Victor, let me hold on with me a second here. We might have the break, but this is exactly the exactly opposite of what was happening in the 1980s when Paul Volcker took over as chairman of the Federal Reserve Board, and interest rates, T-bill rates were 13%. And gold was, on its way, or still up around 600, I believe. And no one believed that interest rates could ever go lower. And that was the start of a 32-year, bear market in interest rates. Interest rates went down for 32 years. And now, even if they raise rates, they're not going to raise them by very much. Okay, we got to take a little break here. Thanks for calling in, Victor. We got the Dow up 7.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can't use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and I put up the long-term weekly chart on gold because it shows the high that was made back on in August of 2011 when we hit 1932 per ounce. Then it shows the Gartley pattern that formed in 2012, also around late August. And that led to this last leg down that we've had that went down to the 61% retracement of the low from 2009, which came in at 1170 per ounce. Now, if you'll notice here on this chart, you're going to see three lower tops with this dark green line that's here that goes back from 2013. The first top came in at the 786, and the one we hit just a few weeks ago that we talked about at that 1340 area, 1345, was a 61% retracement of that level. Now, it's important here that gold holds above this last low, the last fib low at 1240, because if we don't, what's going to happen is this. I'll blow this up and you'll be able to see it, to see what it'll look like, because you could be looking at a really, really bearish pattern in gold coming in. If it breaks that 1240 and then 1270, it would take gold all the way down to $1,000 an ounce without any trouble at all if it starts to break those lows, and that would take them down into October. And that's the main thing that could be happening. Right now, that has not occurred. There's still a good possibility that the 1282 would hold, and then the 1240 right after that. But those are the ones that was looking at. The thing that's interesting about this is that there's been a 23-week cycle in gold that's been operating for the last several years. We bottomed pretty much spot on in May. That gave us the 200-point rally that we got up to, a $200 rally. up to the 1334 level. And so now, that was a $135 rally. And that would tell us that unless we get above that 1240 level, this market is still heading to the downside, and it doesn't look like it's going to, to make any difference. What we might want to do here, folks, is to just to bring this chart out here, because this is the one that you want to remember. I'm going to put this gold chart here and take a picture of this. This is the weekly gold chart from 2011 through 2012. This is what you want to look for in the stock market, folks. You don't have to try to, pick the top in the stock market. That's not important. But when you see this type of Gartley pattern in the stock market, if we ever get one, and we will, that much I feel 100% sure of, that's the one you want to be really ready to change your 401ks and all your other things that you have and get out of stocks completely, because we will have a break somewhere in here. The market might be down, maybe 2 or 3 days in a row. It would probably take a miracle of some kind. But if it does happen, it'll take more than that. It'll be down a few weeks, maybe a month, and it'll be a good buying opportunity. Then you'll have this ABCD pattern forming in stocks, just like we had in gold, just like we had in bonds, just like all of them. They're all the same. No stock, and none of these stock charts are any different. So that's really, what you're looking at when you're doing this. Now, I wanted to also feature the chart of silver, because it is more of an industrial metal. It's still a precious metal, of course. It's one of my favorites, and you'll see that it has already started to break these numbers big time and heading up to the downside with a lot of gusto. In fact, we're almost at that price level that we should be looking at in gold. We've already hit it in silver. We're within about 10 cents of hitting that same move in the silver market. You'll notice that it topped up around the 2150 level at the 786, and then we've come down now. We're at the 382 retracement. We're making an ABCD. That's why it has to hold here, because if it can hold this level at 1240, but frankly, with this wide range we're having today, down over 50 cents, it's really going to be really tough for silver to reverse. But they've changed before, so right now it looks like it's going to break, but it's very close to major support at 12, down about 60 cents at 1240 per ounce. So if that can hold, that means that the silver took out the low of 2 weeks ago, and the gold did not, or the silver did not, and that would tell. Let's try it again, Larry. That means that silver took the low of the 14th out, okay, but the gold has not done that. So that tells us that the silver is ahead of the market as far as correction. So if gold does not correct any more than 1282, that's what you want to be looking at. And that's the fun about pattern recognition, is you don't have to buy it at 1282 and risk $40. You can risk $8 in gold. That's all the stop you have to use. So you can trade a contract that's trading for $126,000, and you only have to risk $800. That's a good risk reward ratio, folks. I wish everything was like that, but unfortunately it's not. We have very few commodities that trade in the $100,000 class. We have some Forex, of course, and we have Treasury bonds. Let me see, 5 times 90. We're almost at 100,000 in the S&P. Wow, did you know when I first started trading the S&P in April of 1982, it was trading at 103? And believe me, folks, the cash was 103, and the futures were trading at a 3-point discount to the cash. So that would be like a 3% discount. That would be like a 27-point discount to the futures, to where it is right now. So things have certainly changed at that time, but who knows? They had to force us to go into the pit that day on April the 16th to get our pictures taken, to act like it was a really, actively traded thing. But it took a long time for the S&P to get moving, because the market didn't make its final bottom until August the 9th of 1982, and then starting in September, the people started migrating into the pit because they knew something was happening, and that started the big bull market that took it from 1982 into August the 25th of 1987, which was the big harmonic convergence spot that topped the market that led to the crash of 87. And we will have another crash someday, but we'll see. I'm not sure when it's going to be. Now, I want to switch over to the corn market because we had a little rally in corn last night. Believe it or not, corn actually rallied about 15 cents off its oversold condition. And as you can see, it immediately went down and went into new low ground once more, which tells us that the bullishness in corn lasted just about 24 hours. That was really short covering, folks. There's not any indication yet that corn is getting ready to make a major bottom in here. Wheat, on the other hand, has a chance of doing it, but corn is still extremely weak. We've only bounced about 6 cents off the bottom here, so there's really nothing to give you any indication of what's really happening. The open interest still remains the same, even with this huge sell-off, which means that the bulls have not given up, and the shorts have certainly not given up. So it's going to be interesting to see how this one plays out, because we're almost in the 1st of August now, and corn will be tasseling pretty soon, and there won't be much they can do about the corn crop because it's going to be pretty much made, and it's going to be a big crop. There's no question about that. Okay, I want to switch over now to something that we all use, and that's the crude oil market with the gasoline and everything. And we have a market very similar to the gold market in some aspects of the chart. We have held the level at $99 a barrel. We rallied up to the 61% retracement in the crude oil during the time of the Ukrainian planes, the Ukrainian, I don't know who did it, but whoever shot the plane down, that's when they did it. And the market, of course, had a big sell-off, thinking World War III was around the corner, much like we did when the Crimea was taken over by Putin. None of that made any difference. And the reason for that is the top isn't in yet. When it is, the market's going to tell you the top is in. It's my personal feeling that it's going to be different this time, because when the doors open for the bulls to get out, the corral is not going to have the doors open. I mean, they're not going to be able to all get out very orderly for a lot of different reasons, but, we'll see if that ever occurs. Hopefully that'll occur in my lifetime. However, those days are drawing short as I'm in the 7th furlong of an 8th furlong race, but we'll see. I know this is my last time at the dance with it, so I want to really take advantage of it and enjoy it when it does occur, because I'll be ready when it finally does. But the crude oil should have some really good support at $100 a barrel. That's what I would think anyway. Now, there is something else in that crude oil complex that is very important, and that is the price of gasoline. I mean, gasoline is, a byproduct of crude oil, of course, as we all know that. That's just an old thing from your high school chemistry days. But if you'll notice on this, on the gasoline, we've already taken out the lows of $99 a barrel that we made in the crude oil. Gasoline keeps going lower and lower. I noticed yesterday that here in Tucson, the gasoline dropped below $3.20 a gallon. We're now trading at $3.19 a gallon, and that we haven't been that low in a very, very long time, well over a year. And as you can see, the gasoline wouldn't even go up with the real bullish news that we had, for the complex anyway, when the Ukrainian episode, I guess, took off. Now, we do have a 61% retracement coming in here at the $2.80 per gallon level. That's down about another 37 cents down. So we'll see if that's going to be a good place. 3.7 cents to the downside. So that is also telling us that we've got some deflationary things out there. That's what's a little scary. If you looked at the grain markets, now the meats have been still strong. We've had a sell-off in some of them, but they're still way up in the air. But all of these commodities are starting to look a little scary. I mean, wheat, corn, and beans are already extremely scary. Now, the soybeans were able to have a very strong rally, but they were the oversold the most, because they dropped, well over $5,000. Oh my gosh, it was $10,000 a bushel. It dropped from the high to the low in the matter of the last 2 weeks. We went from 12.42. That's when we had Rich on, and he thought that soybeans were a good sale, and certainly enough, they dropped $10,000 a bushel, and that's about it. And we'll move this over here, and I'll put this chart in for soybeans, and you'll see that we rallied about 50 cents a bushel, which is the equivalent of $2,500. And we sold off a little bit. Now we're consolidating that. I've had a request for someone to take a look at a coffee chart, and frankly, I don't trade coffee. I don't get data on it. I have no interest in it at all. I think Andy Heck would be able to answer that far better than me, because I don't trade orange juice. I don't trade coffee or some lumber or some of these other exotic things at all. I mean, I'm so busy trading the 8 major cross rates and the 8 or 9 commodities that I do follow that I don't have any time to follow it. And coffee's it's a world commodity, of course, but frankly, I just don't follow it, and I haven't for well over 35 years. So I don't think I'm going to start now, if that's okay. So I'm going to have to pass on looking at a coffee chart. I'm sure Andy, if you go to his show, he'll be able to, give you some ideas of what coffee might be doing. From what I hear about the news, it must be going up because Starbucks raised their prices again, and I'm sure that they do. So I happened to be in Seattle last week for the MTA Market Technicians Association meeting, and they have 2,000 Starbucks in the city of Seattle. I just can't imagine that. And not only that, but the original Starbucks, which is down in the Pikes, near the waterfront at Pike's Place, they have the original Starbucks there. And folks, you have to stand in line almost around the block to go to the original Starbucks, and the people are standing outside with their cell phones and stuff, taking pictures out of it. But the price of coffee there is $2 a cup more than any other place because of the historical significance of the first Starbucks. I don't know where the first McDonald's was. It was probably in California, but I think those days are rather long gone. But it's really something to see that many people standing in line, because it's almost like a prayer event when people go to the Vatican or to Mecca or Salt Lake City. All those things are very, 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 very important. So we'll have to wait and see what happens here. Okay, now I wanted to do one other one that we had in that complex, and that is the heating oil, because you'll see that the heating oil also has not had a rally of any significance at all. It's been in a tremendous down move since mid-June, when it made the ABCD up at the 61% retracement from the high that we made back in February. And now we're trying to make some kind of a bottom around $2.86 a gallon, I believe, to see if crude oil is going to be doing that. Natural gas, it doesn't even have a bottom. So, okay, we got the Dow up about 6, the NASDAQ up about 10, and the S&P up 3.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Okay, we're back, folks, and I posted into Tiger TV for a request from one of our listeners the chart for IWM, which is the ETF for the Russell 2000 Index, and as you can see, it's only been able to make, so far today, it's made a 382 retracement off of the 61% retracement that we made just a few days ago. So we've had a 5-day rally. We've gone to new highs in the S&P, of course, and in the NASDAQ. But I noticed that, some of these stocks that are in the Russell 2000, they're very thinly traded, so I really don't know too much about this index because I don't trade it. I just look at it as something that, people are trading the IWM for sure, but I do want to tell you that I know very little about the index itself. So the chart patterns, I know a lot about that. The index itself, I don't know a great deal about it. I also wanted to mention here, this is the IBB, which is the biotech index. And as you can see, we've rallied up to the 618 retracement. We're a little bit below that right now. I noticed that one of the biotech stocks yesterday tripled in price. It was up $178 to some ridiculous price. I forget what it was. It was $250 40. It was 300% in one day. Evidently, they found a cure for smoking or cancer or something like that, because it certainly was a huge move. These are the kinds of things like we used to see back in 2000 during the dot-com bubble. You remember that? I remember that very, very vividly. I was in the same situation then. I was yelling, the sky is falling, the sky is falling, the sky is falling, and nobody would listen to me. And anyway, thank God I wasn't on the radio show. I didn't start the radio show with Tom, I think, until 2005 or 2006. Yeah, there were 2006, I believe, is when I first started doing it. And but anyway, this is going to be what's happening in the stock market now is going to make 2000 look like an Easter parade, and it's going to make 2008 look like a bear market didn't even happen, because when they finally get in touch with this thing, the history of these patterns is going to prevail. And if it doesn't, they'll be able to say, he went to his grave believing in what he thought was correct. And believe me, folks, I've looked at charts from going back to 1875. I've never seen one that couldn't be explained. The timing not be as good as you might like, but the overall pattern that we're looking at on these long-term patterns, these weeklies and monthlies, they're very, very scary up in here. And the fact that there's no volume can actually be even a more negative thing, because it's a very interesting situation, what we live in. We do live in interesting times, but that happens to be a Chinese curse. So hopefully it will all work itself out. No matter what happens, we're going to be okay. Even if we have a sell-off in the stock market where the market could go down 3 days, they're taking odds in Vegas that might never happen again, that the stock market will not drop 3 days again. Well, that's certainly a possibility. Highly improbable, but that could be something to look forward to. Who knows? Anyway, next week on the Commodity Show, we're going to have Rich Anderson on for sure. He's going to be back in his office, and we'll be able to talk with him. I'm also trying to get Bill Foster, who was on about a year ago, talking about the end of the world, and the market has gone up about 30% since he was on the air, and I wanted to see what his feeling was, if he's still around, and I'm sure he is. We'll see what he's looking at for some of these things. So that's basically it. So live every day in an attitude of gratitude, and may God bless, and do something for a random act of stranger for somebody today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.